Well, hello everyone. This is Ken Winans from Winans Investments, and I hope that you and your family are safe and sound during these very interesting historical times that we live in. Similar to what Franklin Roosevelt did during the Great Depression with his fireside radio chats, I want to produce for you a weekly video to give you the facts as we see them in this office each and every day that affect your portfolio, and hopefully add some clarity to the way that we are trying to take care of things. So as you all know, this current volatility in the stock and bond markets has been caused by the concerns of the effects of the coronavirus on the economy, as well as the oil price war going on right now between Saudi Arabia and Russia. And we don't know yet, and won't know the full extent until earnings come out next month, of the actual damage to the economy. But as speculation draws on these things, good, bad, and ugly, it's causing the volatility to continue to some degree. I also believe that the computerized trading done on computerized exchanges, which is machine on machine, is also driving some of the volatility on a daily basis. So we all know that social media sites are doing their best to scare all of us, certainly me included. I wanted to give you some interesting investment facts that I think might help us in finding a way to navigate this. So as I'm calling it, the 2020 stock market panic, the high to low correction has been 29% in 1 month, and year to date down about 26%. The high to low in bond prices, corporate bond prices, is about 8% in 1 month, or in this month, and 5.6% year to date. So again, what that means is that if you were to go and sell your bonds, you would have a price that's 5.6% lower than where you started the year. Now, there's a lot of media comparisons to 2008, but I actually think this panic, because of the fact it happened so fast, better aligns with the 1987 stock market crash, which stocks went from high to low of 35% over 3.5 months and 32% in 1 month. So this has happened before as far as a panic in the stock market. Bonds also went down during that time. The good news, and certainly something that I'm looking at now, is when you do have these big, huge drawdowns in a very short period of time, it does mean that the bounce back, when it does occur, happens much faster than it did certainly with the 2008 correction. And in the case of the stock market crash in 1987, the market it basically went back to its old highs in just about 2 years, which was really quite amazing when you think about that time frame. I remember it very well. I was a young analyst, and many of Wall Street's big firms went out of business at that time. It's also important to note that most of our income investments themselves have actually held up pretty well, and that's certainly something that we need to keep in mind. But over the next several weeks, or over the last several weeks, we've taken the following steps in most of your portfolios. Again, while most of the bonds and certainly the stocks have held up better than the market, because we've stayed clear of transportation stocks and certainly no banks. We've stayed clear of a lot of the real nasty areas. But last Friday, for the first time since 2008, we made the decision to trim back 50% of our stock positions across the board, and certainly glad that we did. But that also means that we build up a huge amount of cash, and the idea of that cash is to reinvest at lower levels and hopefully get some kind of snapback when the rally does take hold. Also, we put hedges in our portfolios almost 2 weeks ago to help minimize the volatility as well. So with all this being said, when you get your first quarter report, I think you're going to find that, yes, it's not good. I'm not trying to sugarcoat that, but it's not going to be anything close to the disaster that has hit the overall markets. And so I ask you to, before you do knee-jerk type asset allocation changes or monitor things on a daily basis, let's get those quarterly reports and make an assessment based on actual facts. So where do we go from here? Well, the one good thing is all bear markets do come to an end, and in many cases come to an end while the news is still bad. I bring up many times when I talk to people that, in the middle of the Great Depression, the stock market actually hit a bottom in 1932. So there was many, many years of depression later, but the market did recover early in the game. So although it's very tough to pick the actual bottom, we are assembling a list of stocks and bonds that we plan to buy before the rally really takes hold. So I am eyeing on the kind of investments that will get us back to where we were at the start of the year as soon as possible. You know, we're focused on that in a big way, and that the high yields in bonds and preferreds that will attract people. I literally saw this in 2008. Suddenly people realize and say, wait a minute, that bank preferred stock is suddenly paying me 7 or 7.5%, and it's a big bank that's doing well. I want to own that, or a preferred in a food company, or excuse me, a bond in a preferred or in a food company that's suddenly yielding 8%. So the buying will come into the income investments quicker, and they'll actually rebound faster than common stocks. So some other items I wanted to address. We have checked with the custodians who actually hold your investments. In our case, it's TD Ameritrade and it's Charles Schwab. They are both operating with a limited staff, of course, but we are able to get things done. I will caution the one thing that I always bring up during these times of volatility. The web-based pricing that you see on the websites for the custodians, although for common stocks it's accurate, I draw very tight suspicion when they're giving me a bond price or even a preferred stock price, mainly because these vehicles are less liquid and in some cases might not have traded at all that day. So I caution anybody who has these investments in their portfolio to just try to use a little bit of, I don't want to say skepticism, but just certainly some perspective that they might not be as accurate as one might think. I actually think I use it certainly as I would use Zillow to price my house. I think that's probably a good analogy. Other things. You might have known that the deadline for income taxes has been extended from April 15th to July 15th. And I would encourage all of you to, knowing that accountants and certainly our investment firms are on limited staff, it might be better to take advantage of that extension and give people time to catch up, because I think if you take with what you have right now, there's bound to be some mistakes. And in fact, I'm still getting notices that 1099s are still being corrected. So I would suggest take advantage of the extended deadline. Also, if we do not have, or you have not notified us in a fairly long period of time, we do need the contact information for your accountants and attorneys, so we can better coordinate financial matters during this crisis. I mean, for any clients who might unfortunately get sick, your advisors might become very important to you, especially when it comes around the next tax deadline. So I would ask you to please make sure we have that information and that they have the information on us. Many of you have asked how we are protecting our staff at Winans Investments. Well, first off, Nevada is a mid-sized city, 30 miles north of San Francisco, and our office complex is in a very low-density area, so clearly we're staying clear of concentrated areas. Also, many of us live a very short distance from the office and have volunteered to come in for limited periods of time on work days. So there will be somebody here for part of the days, now probably not for the full day, but there will be somebody here to take care of matters. And I would just say this, kind of as a final note. You know, Franklin Roosevelt did say during one of his fireside chats that, the only thing we have to fear is fear itself. And as I drove to work today and I talked to the mailman as he's still doing his route and the grocery stores are still open, I would just suggest that we need to add some perspective to this, although take it very serious. But I do think we have to be careful not to work ourselves into such a frenzy. I would also say, too, that a lot of the things that are being thrown out, we still don't really have all the facts yet. So, I'm one of these people that I hope for the best but expect the worst. Finally, I've said it in my last broadcast, the primary job of a money manager is to make money in good times and protect and minimize losses in bad times. I'm very proud of our team. I think we've done an outstanding job as we've looked at the portfolios on how we've navigated this crisis, and we are committed to putting a game plan together that will allow our clients to make back their money as fast as possible in a meaningful way, not overly ambitious, but just like it was with 2008, we were able to retract those terrible losses in I think it was about a 14 to 15 month period of time. So just rest assured that our job is to come up with strategies to have that happen. So listen, I want to thank you for being a client. I know it's tough during this time to be patient through this. But please call if you want to go over anything. Granted, it can be a little difficult from time to time, but I just hope you're all doing well. And thank you for your emails and express concerns for us. And I'll talk to you next week. Thank you. Bye-bye.